Go easy on us, huh? Well, we all know retail sales was pretty good in our recent release, so we're hoping this broader measure gives us some idea what's going on with respect to income and spending. Personal income up exactly the amount expected, up 0.3%. And if we look at the spending side, it's double expectations, Joe. So far, so good. Up 0.4. We're expecting up 0.2. And on real personal spending, it moderated, but it's still a positive number. It's up 0.1, exactly as expected, a little light in the rearview mirror. But now we're getting into the thick of it. The personal consumption expenditure deflator, month over month, expected to be up 0.1, shoots up to up 0.3, up 0.3, much more than expected. And if we go year over year, and this might be the most important number of the day, 6.2%. We're expecting a number at 6%. The recent read was 6.3. The high water mark was in June at 6.8. That was the highest since 1982. And if we look at the deflator month over month, it's up 0.6. And 0.6 is 1/10 hotter than expected and basically equals our high water mark, which was April, and that took us back to 2001. And if we look at the year over year core deflator, it's up 4.9, 0.2 hotter than expected. And in the rearview mirror, it was up 4.6, which now gets upgraded to 4.7, so 0.2 higher. And if we consider the high water mark here was well above current levels, actually. It was 6.8. That took us back to 1981. So even though it's higher than we want, it's definitely moderated a bit, but I do think the year-over-year deflator is something to pay attention to, and the market will. And let's remember, if you look at where twos, tens, and dollar index are today at the end of the last quarter, twos were at 295, tens were barely above 3%, literally like 301, and the dollar index was a bit higher than 104.5. Big, big, big numbers. And as you heard Peter, the derivatives world, it's hard to pay attention to all the different derivatives out there. There are a variety of them. And many of them, of course, have one big problem that's very difficult to hedge away. It's option volatility. And believe me, that has been a big area of risk that's very difficult to control. Andrew, back to you.
Hey, Rick, before you go, as you were speaking, I don't know if you saw it, but equities at first turned red, even more so than they had been earlier in the morning, and then bounced back, and then bounced back again. I'm curious what you think your read of this is in terms of what you think the equity market should be thinking and maybe what Jay Powell should be thinking this morning.
Well, I can't tell you what Jay Powell's thinking. I can't follow the Federal Reserve. I'm not really a big fan of their big hammer strategy. But I think with respect to the market, you have to be careful, Andrew. It's Friday. It's Friday, and it's the end of a quarter, last trading day. So I'm not sure today's activity is going to give you a good glimpse of a reality. I would suspect to see some more buying in the Treasury complex, keeping yields lower, but that may end. Listen, I am a big proponent of the bounces and bear markets and the equities. I still say if I take a big step back, maybe people aren't going to want to hear this, I've been at 3,250 to 3,300 in the S&P, and that's still well below where we're at. So I cannot get optimistic on stocks.
But how hot was on it? Like, how would you describe the level of the heat for the inflation data that we got? Rick, was it worse than expected, but could it have even been worse?
Oh, yeah. Here's the problem, Joe. If I look at this data, I jump to one large conclusion. Just like Jerome Schneider of PIMCO yesterday that I interviewed. Is that a year down the road, I suspect inflation is going to be cooler. And I suspect if you look at where most of the yield curve is now, it might be sufficient. But the real question we need to ask is, are today's numbers going to satisfy the Fed? And in my opinion, the answer is no. They're going to be looking at 6.2 hotter than expected, not carrying it peaked at 6.8. And I think that the same could be true for the year-over-year core deflator. So I think to answer your question, no, the Federal Reserve wants to see much more of a cushion before they take their neck off the chopping board.